So tell me about the move from Goldman to Sixth Street Partners. Not so much about why you personally did it, but what does it represent in your mind about larger trends in Wall Street and in investing?
Yeah, if you go back 20 or 30 years, I would say private equity was a relatively niche area. Private credit was, people didn't really talk about private credit. It was, there was middle market lending going on at banks. Certainly, you had hedge funds out there who may do the odd private loan here and there. Infrastructure really wasn't, on the tip of everybody's tongue. And what you've seen is just this gradual trend over the last 20 or 30 years. As you saw some of the early movers into alternatives back in the 80s and 90s, the endowments and the state pension plans, they were generating tremendous returns from the asset class. This was giving rise to increased allocations towards initially private equity, but then wanting to broaden into other diversifiers. And then subsequently that brought in other capital. So you've seen like a greater interest in investing in private capital, which means the roles for banks has just changed. There's still an incredibly important role for banks to play as a financier, as an intermediary, as an advisor around these given situations. But actually the retention of the risk capital in these deals, whether it's owning the private equity transaction or owning the junior debt tranches, owning the real estate asset, is increasingly just moving into the hands of long-dated private capital that typically, if structured right, has a liability set which is matched against the assets that they're invested in.
We have a tendency in financial media to talk about active investing, passive investing. What about active management and passive management in this sense? We had Tony James on a little while ago, and he said in private equity, it evolves from something that was basically a financial transaction. We'd leverage things up, we could make money, you could flip it. In private equity, increasingly, you have to actually manage the business, make some changes to the business, make it more valuable. Are you seeing that with the various vehicles you're looking at, that you are more involved in the business?
Absolutely. I think about there's a continuum of investments that you can make, some which are relatively more passive and some that require very active involvement. And one could say, building a company from scratch or scaling up a platform, controlled private equity being the most active form of active management. And there's a continuum in between. And I think what you're going to see over time is areas where you're simply an intermediary between capital from a client going into a situation where it's a relatively light touch will be harder to prove value and add value. And if whereas the more actively managed situations, you can really demonstrate to your clients that you're adding value to them, but also you're a better solution provider to the company that you're investing in.
Given what you said, Julian, I'm not going to ask you what categories, private equity versus private credit versus something else, make the most sense, because what you said is it depends. Depends on the problem. We'll use different tools for different purposes. What about sectors? One of the things that we're hearing a lot about right now, for example, is infrastructure. You've seen some big deals now in infrastructure with some other investment firms. Is that a real opportunity that you're looking at going forward?
Look, I think it's pretty consensus that there's some big long-term themes that everybody's spending time on. I would say infrastructure is one of those because that kind of ties into a number of themes: digital transformation of the economy, reorienting of the energy infrastructure across the globe, decarbonization. I think that the demographic shifts, and then also the deglobalization trends that we're seeing with more businesses wanting to not necessarily exit en masse from certain markets, but at least to think more about supply chain certainty and security. And all of those mega trends essentially necessitate infrastructure investment. And that will give rise to tremendous investment opportunities, trillions of dollars that need to be invested in infrastructure in the coming decades. Now, just because the infrastructure needs to be built and will be built doesn't mean that it's all going to be an uphill kind of trend in terms of making money from these things. Some of the greatest infrastructure projects I can think of, the first investors lost money, and you wanted to be the second or the third guy to come in and invest in those situations. But I think those kind of broader trends are there. Now, there are opportunities to make money in that, but then also around the edges. So, for example, proliferation of data center investments is much needed, but that's helping fuel growth in the software industry more broadly. So there's a whole range of investments you can make across the software space that's benefiting from cloud computing and other computing resources to help them scale and grow. But I think that's absolutely a big investment. But what's going to be very important is to look at allocation of capital. Some of the returns in that space can be quite thin and quite rate sensitive. And you've seen what's happened in the real estate market in recent quarters, where the full rate sensitivity of those investments has really been brought to people are now it's becoming very clear to people how rate sensitive those investments really were, and I think some of those same issues could exist in the infrastructure space.
One of the advantages sometimes people have is having patient capital, because you have to make long-term investments. You have to have patient capital. How is Sixth Street Partners function in terms of patience of the capital you're working with?
Look, if you go back over many generations, the things that cause the greatest problems in financial institutions and funds is asset liability mismatches. And it's a lesson that gets learned time and time again. And just when you think people aren't going to make the same mistake again, they make the same mistake again. So I think getting this asset liability mismatch or avoiding an asset liability mismatch is critical. If you have the wrong kinds of liabilities, it forces you to make suboptimal investments. It may force you to invest at a time that you don't want to invest. It may force you to sell at a time you don't want to sell. So I think lining up, it's always you can't think about an investment without thinking about your liability structure. One of the things I used to think about at my old firm was a wonderful institution, great training ground for investment excellence, but in the way we used to run the business before we started raising third-party capital, you weren't really out there on a day-to-day basis talking to clients, and that's kind of very, very important, because it informs your opinion to some extent, about the businesses that you want to build and grow to match against those client demands. But it also helps you understand the likely pricing of liabilities on a go-forward basis.